It is now my pleasure to introduce Campbell Roche to you. Campbell is the Senior Managing Director and Dallas office co-head for JLL. He has a wealth of knowledge and is going to update us on capital markets. You're in for a treat. Welcome, Campbell.
Thank you, Mackenzie. Good morning. For those of you who may have seen one of our capital markets overviews in the past, you know that we are typically sprinting to get through everything that we try to in 60 minutes. And so in order to hit all of this in 10 minutes, it's going to be fairly abbreviated and quick. And so bear with me as we move fast through this. Before we jump into key themes for 2026, I think it's important to talk a little bit about where we've been. And as everyone in this room is acutely aware, the commercial real estate industry started a new cycle in the spring of 2022 in response to the Fed dramatically increasing interest rates as they worked to slow down inflation. And with that, pretty dramatically dislocating our interest rate environment. 10-year Treasury went from less than 1% to 5% in under 18 months. And through any kind of underwriting methodology that we may apply to the market, kind of in disarray. And so the predominant theme that we've heard from most investors over the past 3.5 years has been, where are rates? Where are rates going? What's the monetary policy? How do I underwrite my deal if I don't know what rates are going to be next week, let alone in 5 years when I try to exit? What you're going to hear today is we're seeing the volatility of the 10-year Treasury yield moderate, and the shift in focus is going from where are rates to how do I optimize my operations? And with that, what is GDP growing? What are the tailwinds in the business and the industry that could allow my tenants to grow their rents and my NOI? So let's jump into it. As we speak with investors, we're asking the question, where are you finding opportunity today? And the truth is, across any asset class, it's a pretty challenging world to invest into at this moment because everything feels pretty rich. Since 2022, the equity market's up 75% and at or near all-time highs. Any kind of fixed income instrument, investment grade or non-investment grade, is pricing at historically tight spreads. Private credit's pricing at historically tight spreads. And meanwhile, commercial real estate's repriced downward 20 to 25% off a peak. And we're starting to see an upward trend, retrenchment and value gain of about 7% as yields compress. And so what we're hearing from investors is saying real estate's presenting an attractive relative value. And we're anticipating that that's going to be a theme that continues to play out in 26 and beyond as they're trying to find a place to safely deploy new capital. I think this chart's pretty interesting, so let me just break it down. These blue bars are the number of bids that JLL has received as a firm across the country at any given quarter. The tan squiggly line at the top is the 10-year Treasury yield volatility. And the blue squiggly line is what is the market and economists projecting for the forward-looking GDP growth. As I mentioned in the intro, because of the volatility in the 10-year Treasury, investors haven't had conviction of what to underwrite or how to deploy. So to the extent they are bidding, they're bidding pretty conservatively. And there's been a persistent bid-ask gap, which has limited transactions. What we saw really coming out of Liberation Day, and especially in the second half of 25, is that we finally found a bound range of 10-year Treasury movement within about 25 basis points. It was very seldom since 22 that we'd have the Treasury stay within 25 basis points for 3 consecutive months. At any point when you thought you finally got to some level of consistency, there'd be a truth post or a bank failure or whatever it may be that caused everything to go back into disarray. We finally seem to have some sort of firm footing from a 10-year interest rate perspective, and at the same time, surprisingly strong forward-looking GDP growth. And coming into 2025, so going into last year, economists were projecting that the GDP was going to grow 1.9%, real GDP. We ended up growing 2%, which is great. Going into 26, the projection is that real GDP could grow as much as 2.4%, which is massive. But what's truly staggering is that 2 weeks ago, the Atlanta Fed came out and said, actually, GDP could grow as much as 5.1 to 5.4%, which is a massive number for an economy of our scale and size and something that we haven't seen in a really long time. And so as real estate investors, if that were to play through, we could equate that to strong tenant demand, absorption needs, et cetera, and with that NOI growth, which I think is something that everyone in this room would be pretty pleased to see. There really hasn't been a lack of capital for the past 3.5 years, despite the slowdown in transaction volume. Capital has been formed and looking for a home. It's been a pricing equation. It's been uncertainty around how you value and price real estate. The one exception to that may be core capital at scale. I think the Odysseys, which historically have been some of the most active investors in the core capital, they've been going through their own challenging math equation of their NAV values versus market values. They've had exit queues, so they've been slower to invest. So core at scale has been a challenge, although we're seeing some new capital form coming into that space, both in separately managed accounts and sovereign wealth funds, and also into the retail network as 401ks are coming back into real estate. And surprising to some, although every lender in here would know this, the debt markets are uber aggressive and uber competitive. It is frankly staggering to see how competitive that space has become in a very short time. So this bar chart's reflecting how much dry powder, capital raised and available, is available to invest in commercial real estate. And you can see from 2019 to present, liquidity, so dry powder available real estate, is up 80%, and transaction volume, opportunities to invest into deals, is down 30%. So you have this huge mismatch of capital looking for a home and very few opportunities, which is one of the reasons why we're seeing the bid-ask gap narrow as there's increasing pressure to deploy. At the end of the summer this past year, you may have seen that the administration issued an executive order called the Democratization of Investing into Alternative Assets for 401ks. It's a mouthful. Really what they did was they limited the red tape, or they started the process to limit the red tape to make it more accessible to invest into private real estate out of your 401k, and private equity and crypto and some other asset classes. If you assume that this plays forward and just 3% of the current asset base that sit within 401ks were to be redistributed into private real estate, that would mean an additional dry powder of nearly $400 billion, which is almost twice the NAV of the current Odyssey funds. And so you have this formation of, frankly, new capital to the space that we haven't seen before that could be a massive player in core real estate and allow us to see continued pricing power in that sector, which is a huge benefit. The bar chart here is showing debt volumes that JLL put under application by month, and I think what you're going to see is really second half of 2025 averaged over $8 billion per month and was off the charts. The run rate for the end of 2025 was in line with previous peak levels of 2021. So debt activity has been robust. I think it's often being used as a surrogate for transaction sales. If a developer doesn't like their exit price once they build a deal, they're choosing to go refinance into a really attractive debt as opposed to selling. I think one thing to note, maybe to give lenders in here hope, is that 82% of the financings that we've worked on since 2022 have been 5 years in duration or shorter, which is a massive change in the market from what we saw from 2008 to 22. And so that means there's going to be a lot more maturities coming down the line and opportunity to go to redeploy that capital. 21, half of the financing activity was acquisition financing. In 25, it was 23%. So we really haven't seen the return of acquisitions or acquisition financing. And so the combination of those maturities and the acquisition market picking up should create additional opportunity for lenders to go deploy capital. One area that we've seen some of the most liquidity or change in liquidity is in the large loan space. So this is just reflective of the number of quotes we've received on financing assignments where loans requests were more than $100 million for 2024 and 2025. And I think the takeaway here is of the $72 billion that we marketed for financing, we received quotes at an aggregate were about $600 billion in volume. So think about how much dry powder did not find a home or an opportunity to deploy and is continuing to go look for new opportunities going forward. In 23 and 24, really the most successful fund management capital raise venture structure was private credit. People were transitioning out of equity, raising equity for private equity funds and into debt funds. And so a lot of capital was raised from institutional LPs to go deploy into the private credit space, and there just haven't been enough opportunities for all those dollars to go to work. I think from an institutional capital perspective, we've seen investors take on a risk-on posture, really kind of a commencement of a new liquidity cycle going back to August of this past year. That's continuing to play forward. The return of institutional capital to the space is going to allow there to be pricing power, frankly, and hopefully appreciation asset values. With that, we're seeing some level of capitulation and conviction, however you want to call it, but a narrowing of the bid-ask gap. In 23, we pulled 30 of our largest investors that account for about $1 trillion assets under management. And the market is pretty interesting to see the consensus. They all wanted to sell at a 4.5 cap, and they all wanted to buy at a 5.5 cap. And obviously, there's not many transactions that are going to occur when you're that far apart. And today, that gap, I would say, is about 25 basis points apart, and it's knocking a lot more sales transactions loose. I do want to touch on here at the end, and I'll have a slide on this. It's for the developers in the room, we feel your pain. It's continuing to be challenging to raise equity for new development. We're seeing some positive thawing there, but understand that that continues to be a little bit of a challenge. So LPs, the same group of 30 we pulled in the fourth quarter of this last year, we said is right now a great time to invest. 98% said they agree or strongly agree. So institutional capital is recognizing that partly because of the relative value, partly because of the fundamentals, partly because of the GDP growth story, it's a good opportunity to go invest in commercial real estate. What's also interesting is 50% of them said they were pleasantly surprised that cap rates were actually lower than what they thought they were going to be 12 months ago. So they were surprised to the positive. The market's a little bit more aggressive than they had underwritten and had planned on. In 2023, the narrative was institutional capital selling to private buyers. And it kind of makes sense because a lot of institutional capital is subject to groupthink. They have investment committees that dictate when and how they deploy. Private capital is a little bit more limber. And that's fine, but private capital by nature is limited. It's not as deep pockets. It's a little bit more disciplined in terms of pricing in some cases. And what we've seen in the past 12 months, in 2025 especially, is that the return of institutional capital is 23% of acquisition volumes in 2023, 33% in 2025. And if you look at transactions over 100 million, they're almost 50% of the market. So more deep pockets, more certainty of execution, more pricing power. And then finally, on the development market, we are seeing an uptick in construction loans, kind of in line with the pre-pandemic level. The left chart is really showing number of loans. So I would say these are probably weighted towards smaller transactions. It's not as much developments of scale as we've seen in the past. The right bar chart is showing joint venture equity volume that we as a firm have raised. We did 52 development JVs last year, which is about $1.5 billion in equity raised, which doesn't sound half bad until you compare that to 2022. When we did $5.5 billion, and so we're down about 77% over previous peaks. Certainly have some room to go there. So in summary, I would say from a capital market perspective, looking in 2026, all systems are go. And we really, as you stack up and compare to different points in time, we have 2007, 19, 21, and 23. Today is presenting to be one of the more favorable starts to a new year that we've seen in quite a while. Capital flows are growing into the space, which is good for everybody. Commercial real estate's presenting an attractive relative value as compared to other asset classes in the market. Credit's highly liquid and cost of capital is compressing. And then positive for all of us, commercial real estate fundamentals are improving. Maybe one asterisk around multi that I'll let Drew Kyle hit in a moment. But with a slowdown in supply and these GDP tailwinds that we're all feeling, fundamental growth should continue to improve. So thank you very much. I'd like to pass on the torch to Scott Bennett with Beck to talk about the construction industry.